This is Justin Pulitzer. This is my weekend review video for Sunday, December 13th, 2015. However, it's being recorded on the 12th, Saturday, so I don't have the benefit of seeing what the futures look like on Sunday night, but I do have levels and I do have a lot to discuss. Anyhow, let's just get to the 800-pound gorilla in the room, and that's the Fed. We know we have the Fed decision coming down on the 16th. There's been a lot of, I guess, fear about what they're going to do. This is the first meeting, I guess, since maybe 7 years ago that they really is a big danger of them raising interest rates. I think the probability is something about 80% at this point that they might raise interest rates on Wednesday. That's the 16th. So what has been happening? Seasonally, this is December has a couple of phenomena that go on. There's tax loss selling as well as Santa rallies that do often take place. I think what's happening here is a lot of funds that have big gains in those FANG type of stocks, the Facebooks, the Amazons, the Netflix, the Googles, etc. They're doing what's known as a lock-in here. And big funds have something called VAR, value at risk, and I believe what they're doing here is they're taking down some of their value at risk ahead of the Fed decision. There's also been a lot of fear. The market, I've discussed my 6 market keys, and I'm going to run through them quickly. The VIX, the dollar, the bonds, the oil, China, and the and biotech. And at any given point, any one of those can really take over. And the market's really been keying off of oil as the proxy for global growth, and it has just been getting demolished. So that, I believe, has also been one of the big problems, I guess, or struggles for the market over the last week or so. There's also, of course, you're getting some big mergers here. We had Pfizer and Allergan, and then this week we had DuPont and Dow Chemical. And, you know, I think a lot of people believe when you start getting these big mergers, when markets have had big runs, that maybe we're at a market top. There's going to be also a new theme I'm going to discuss a little bit in this video, and that has to do with corporate and high-yield debt, also known as junk bonds. And those have been in a lot of trouble over the last few months, and I think it's just recently starting to get some more media attention. I've been watching it. I haven't really been discussing it because it hasn't really been one of the key market factors yet, but that could become a really big problem, and we're going to go through that in a minute. So let's just start off with at the top of the key, so to speak, little basketball for you. With the VIX. So I had warned over here that last week in the video that if you're going to play, it's time to do it by not selling premium, and it's to do it directionally with options, either puts or calls, and that I guess prognostication turned out to be quite prescient because we all see what happened with the VIX. We've had a huge spike. If you were short IV here, you got yourself pretty badly banged up. So there is a little bit of a problem in this pattern here. You have a higher low and now subsequent 3 higher highs. That could be trouble for the market. The good news is that we've respected some important levels. You can see we're at the 1785, started as a little bit of some resistance. Of course, 20 to 22 is always a important level, but Friday the panic really got going, and we got up to 25.20. I will say this with regard to volatility. You can see here this was the last time we really had the big. This was the crash, the recent flash crash correction on the 21st. The good news is 25.20 did reject here. You can see we got up to 25.27 and it backed off a bit, so we did have a close below 25, which is good. Here I had warned that we had a close above 25 and that puts crash risk into place, and we can see what happened here. You had a spike the next day to 53. It more than doubled. That was that's real trouble. It's good here that it backed off. The bad news is that if this continues, the next real important level here you can see is this reference high is 28.27, and I think that we would probably see the 31s if this continued up. That would be a lot of pain in the stock market. Why is this IV popping? Probably because of the expected move. I guess it's kind of baking in a larger expected move for the S&P. It's currently about $7 plus or minus. We're going to go over that in a minute. My big concern for the market has been the dollar. The good news is that this is mitigating a little bit. This is good and bad news because this is one of the things the Fed has mentioned that they're concerned about. And if the dollar was coming into the Fed meeting strong, it might hurt their ability to look to raise. But it could also mean that they might not want to raise, or that the market is anticipating less raises. We broke back into range. This was a pretty big break. They tried to rally it back up. You can see it couldn't hold above the 25.68 range high, and now we're coming back and getting close to retesting the breakout level of the dollar. So if it holds here, that to me could still be a big problem, a headwind for the market, because this could easily smack back up. The best case scenario would be for the Fed decision to come out and for this to come down. A lot of companies increasingly are doing business overseas. We all know that the weaker oil will help global growth in the bigger picture, although it is startily contracting right now. I will go over that in a moment. And the a weaker dollar would help U.S. exports, particularly for the big durable goods types of companies like the Caterpillars and the Boeings. Anyhow, that is the dollar. The risk, like I said, is that this holds and this goes up. The good news is it's making lower lows. So this is I believe a net positive, although it isn't kind of going to help the case with the Fed. So, rate hike? What rate hike? TLT is above 123.15. That's the crash peak from 2009, and you can see they tried to break it down. It held. I talked about 118s being key, 117, 118 really being the fulcrum strikes. We didn't even get down there, and it just rallied back up over these highs here, back into the up channel, above the crash peak high, higher low, higher high, good pattern. A little caution, though, is look where we topped out, basically at this gap fill, and kind of getting close to the end of this volume distribution. You can see it tapers off up here, so there could be a little bit more room to go in TLT to the upside, to maybe to 126s, 125s, 126s, but this can change very quickly. If the Fed hikes, this might have might want to fall out of bed, but this is kind of acting like maybe the Fed might not want to hike. I never like when things rally into the print, so to speak, and this would be the equivalent of a stock rallying into their earnings only to get whack-a-root again. But, bonds are a little bit of a strange beast. If we're looking like we're going into recession, these bonds will rally no matter what. That's just kind of how it, de-risking happens, that there's a flight to safety. And this is sort of where people are going to put their money. That's the bonds. USO. We have a huge inflation problem in this country right now, and we need interest rates to go higher because oil just can't stop going higher, right? Obviously, my sarcasm there is what it is here. Oil is still in a steep decline. The Fed, keeps talking about this theoretical potential future inflation, and they're talking about mitigating the, commodity crash in 2016, and it's all this academic crap. Really, that's what it is. I'm sorry. The people who run the Fed are basically professors. They've never worked on a trading desk. They've never traded in a commodities or a futures pit. And, we don't have theoretical inflation here. We have very real deflation. And I'm going to go through a few charts And I'm sorry if my voice sounds angry, but it is. I'm pretty pissed when I hear this kind of crap that comes out of the traditional financial media and out of people that are unelected officials that are, guarding our money supply and are majorly responsible for the well-being of the economy at this point, since we don't have anything helping in terms of fiscal policy. Just a side note, there was a note that came out about where Americans are spending their money, and a lot of it is into healthcare. Obamacare is coming online big time, and it is very expensive, and I don't believe is... Anyway, I don't want to get too into that, but there are a lot of things that are happening in the economy, and inflation isn't really one of them, other than, artificial ones created by the government. Anyway, oil is in collapse mode. USO is making new lows. We're below this 1237. There is. I just want to flip to the oil contract quickly. The CL. We are coming into some important reference lows. We're below the 37 breakout from the 2009 crash low consolidation, and the reference low there is 3320. I do believe that we have come down a lot. There should be some support here, at least a reference bounce. But, if this is a barometer of global growth, I realize, yes, the Saudis are pumping, and I believe OPEC is busted at this point. Iran is coming online. We have been slowing our rig counts here. I think this was the biggest drop. I think 21 rigs came off on the Baker Hughes report, but the Saudis are still pumping. They're making a play for market share, and this could go down quite a bit. I believe that at some point oil is going to bottom, and we will be talking about this being the good old days with regard to oil, but this could also be, I've heard a lot of people talk about lower for longer in energy. Maybe that happens. I've talked about that being like a jackboot on the throat of global growth for a long time. This will help Europe and Asia, and as long as they're devaluing, and China is devaluing, and Europe we know is devaluing, this will help their economies. These are countries with huge unemployment rates in very youthful populations who tend to be the ones that lead rebellions. And I believe this will be a net positive in the big picture for them. Short term, this is contractionary. This will hurt GDP for this country. So that's oil. The way I like playing oil is with these big integrateds, the Exxons. I had this in a put ratio. I closed some of the short exposure. I have a little bit of net long as a tester, although I'm a little less confident that fact that this came down to the 61.8, pushed through a little bit, had the bounce, two kind of cruddy topping tails, and then now back down. This really should be this was the breakout between the 75 and like the 74. So if this doesn't really hold, we could come back further into range to the 72s. And, this could really be in danger of retesting these lows if oil really falls apart. But I believe that the dividends in these types of stocks are probably going to be safer than in other types of more levered plays. Like we could talk about the Kinder Morgans. I don't really want to get into that, but that's a big pipeline. Maybe I'll talk about it quickly. KMI, that's a big one. You could see this just completely collapsed. It's having a bit of a responsive bounce after they cut their dividend. A lot of people thought they were going to cut their dividend in half. They cut it by 75%. These are companies that used a lot of leverage, and they are suffering tremendously. That is deflationary. I believe on Friday there was a bond fund that was in this high yield. I forget the name, but they were they basically are in liquidation mode. There's a lot of bond funds that are closing in liquidation mode. And, this is starting to feel a little... I don't believe that you have systemic risk in the banking system like you had in 2007, 8, and 9. But, this could cause a lot of pain, kind of bring on the heartache. Let me jump into this high yield just to show you what I'm talking about, because this is a really good segue. Look at this HYG, this HYG. This is the high yield. Does this look healthy to you, the viewer? You've had a 50% retracement off the highs. Let me go into a longer-term chart. 5-year weekly. That's not even good enough. Let's do 10-year weekly. So this is what happened in the crash. We've had a bit of a rebound, and now we're rolling over. We're into some. The good news is we're into some reference lows and some Fibonacci retracement areas. It's good that the 50 had some responsive buyers. We are below kind of the channel low, so we are getting near-term oversold. There could be some responsive bounce, but this is not a healthy pattern. And to me, this is kind of looking a little bit like we looked here. I mean, look at this trajectory. And then this is really when it started getting steep. There's some risk here. You had a lot of volume. It's kind of picking up. This vicious cycle can get a little scary. JNK also a little iffy here. Looking like we're in danger of some more steep declines. I assure you, if this starts getting steep like this, the stock market is going to get steep like this. Bonds, I worked very briefly for a Wall Street firm when I was out of college, and in my experience, the bond guys are the smarter ones over the equity guys. Whenever I was kind of curious about what was going on with the market, I used to go see some of the bond guys and just get a feel for what they were thinking. And I assure you that if this picks up, the market is going to get a little bit more squirrely. We are oversold, like I said, so I wouldn't start initiating shorts right here. I'd prefer to do it on some type of bounce action, but this is very concerning. And if this starts getting steeper, you're going to start hearing about this on the front line. The Fed should be all over this because this is kind of where it starts, so to speak. And I really don't understand what the hell they're talking about. They're talking about this theoretical inflation and things are going well. They're not. We're going to talk about the Fed keys in a minute. I don't want to jump right into them, although this would be a logical segue, but let's get through the 6 market keys first. The other one, the Fed had mentioned that they were worried about is China. We know that Chair Yellen the other day was saying that, some of the concerns about overseas were mitigating. That was back in these rah-rah days. We were still in the channel. However, we have fallen out of the channel, out of bed, into some reference lows, this pullback low. It's also a 78.6 fib retracement. It's also kind of getting close to the tail end of a volume distribution here. So this could be some right or right out action. However, when China is in crash mode, it is not good for our markets, as we know from previous experiences. When we were crashing here, the S&P couldn't catch a bid. So now you have China. We're below trend again. We're down. I mean, this is a lot. These are big moves in a big index. I'll show you. This wasn't so unpredictable. I had been kind of bullish on this. I said here we were up near the upper part of the channel. I was concerned. Look where we got up to. This was the neckline of the real breakdown from back here. You punched through here. This is a overseas ETF, so it's always going to trade in gaps if you're wondering why this is so gappy. But look at this, consolidated here, really the major breakdown. Look at this, got back up and now breaking down again. This could be looking for a double bottom, or it could be looking to really punch through. This is really where it needs to hold, in my opinion, and it's getting really, really iffy. Fed should be paying attention. IBB. So everyone always talks about how cheap the biotechs are based on earnings. Industries always look the cheapest when they are at peak earnings. We know Hillary Clinton is talking tough about regulation. Bernie Sanders, who has no chance of getting elected in my opinion, but Hillary Clinton may. And this is very concerning. You have a potential inverse head and shoulders here setting up, although this is starting to look like it might be a fail one. I said the other day that we really need to see this 341.25 to 342.89 taken out, and then it could be off to the races for a move back up to 356s and 360s. We're not doing that. We're consolidating. We were consolidating around the 50, and now we have a breakdown with a close below this reversal bar. That's bearish. I mean, I'm sorry. It just is. That's the close here was 321.97. The close here was 319.89. Below that and below all these days is iffy. We could want to retest back down into this area. So very cautious with these. My favorite of these is the Gilead. The Gilead, right? I had said that we were in a triangle here and wait for the break, and it looks like we're breaking down. Lower highs, lower lows. We all know that pattern. We could want to retest and fill up the triangle down to 93s, maybe even finally to the 85s. I would be an interested put seller down here, particularly if it's in cascade fashion. I also believe that Janet Yellen had talked tough about social media and biotechs, and the algos are kind of unofficially keyed into these, so that's probably why you're having some weakness in the Facebooks. We're going to get to that in a little bit. Anyway, we're done with the 6 market keys. Now let's talk about the 6 Fed keys. So the Fed keys off of 6 things, and there's a 7th one that's a little artificial. I'm going to talk about that in a minute. So let's do it. So the Fed keys off of 6 important numbers, a 7th being unofficially. I'm going to reveal that in a minute. If you follow me on the Periscope and you followed my videos before, you already know it. But the first one is the non-farm payrolls number, the jobs report. We know we had a little bit of a stronger number this time, although I'm curious to see how that does with revisions. We know retail is awful. The quality of these jobs are not really good. A lot of them are part-time. We've become a country of waiters, waitresses, and God knows what other professions that are part-time. That I think a lot of companies are moving away to part-timing to avoid the Obamacare tax. We all know they're offshoring. The job quality, we know the amount of money people are making has not really increased. The amount of pay has been low. The percentage of the population is still at really record lows. These reporters get excited with incremental tick-ups of like 0.1%. That's ridiculous. I mean, I live in New York City. The cost of dining out has gotten expensive. I go out to a restaurant, 10 years ago, even 7 years ago, entrees at places, if you didn't order steak, were like in the teens, 15 to 18. Now you go to a place, just even like a mediocre place, and they're in the mid-20s. So dining is expensive. Rents, we've become a nation of renters. We're about 6% above the historical high of owners to renters. Rents are going up, although I will tell you I'm starting to see some of the market in that area cool off a bit, even a bit of some price declines. Transportation is expensive. We all know that it's kind of becoming a bit of an Uber society. That's also, I guess, part of these part-time jobbers. And healthcare. Healthcare is up huge. I mean, once you get past that, there's not a lot of disposable income left, and I guess that's probably why people are spending less. We've also had a warmer, holiday season, and people are, I guess, a little bit less. Anyway, I don't want to get too into this, but things are not going as well. The GDP number, that's another big one. The Atlanta Fed came out. It was originally supposed to be 2.3%. Then they lowered it to 1.9. Then it was lowered to 1.3 or 1.4. Now, after the numbers the other day, they're back up to 1.9. 1.9 GDP is below 2%. That is stall speed. If you have an earthquake, a major terror attack, even just a cyclical downturn in terms of anything that goes wrong, that number could go negative. We know we've had very weak first quarters for the last 2 years. I'm in the opinion the Fed should wait and see what the fourth quarter was, and they should wait and see what the first quarter is, and then talk about raising interest rates maybe in March. If things are still slow then they should really be doing more QE in the summer. One more thing to mention, that this GDP number, they have a lot of revisions. I really believe that they should see a couple of quarters back-to-back of more stabilized growth before they even consider raising. I don't want to get too into this. It's a bit of a backtrack with jobs, but there is a lot of technological innovation with regard to supply chain management that's happening, and that is, I believe, going to eat into the jobs numbers even more significantly in the next 5 to 10 years. It's not something I hear talked about a lot here, but I believe it's going to start hitting white-collar jobs too soon. I don't want to get, like I said, I don't want to get too into that because it's not as relevant right now, but it is real. This stuff is happening. ISM kind of crappy was I'm not going to say kind of crappy. It was crappy. It was a contractionary or recessionary number. I don't want to go too into what these numbers mean because we'll do a whole video just on this. PMI also negative. That was contractionary. By the way, with regard to the ISM, the industrial one was negative, and I heard these, reporter guys saying, oh, not a big deal. We're a service industry. Not as big of a manufacturing, not as important. Yeah, until the ISM, the service ISM came out, and that was contractionary also. So both ISMs recessionary, PMI recessionary. Durable goods, yeah, it was a decent number. A lot of that was planes and autos. And then the other one that people talk about is housing being strong. Housing and autos are very, very dependent on low interest rates. You start raising interest rates, those numbers are going to start looking kind of junky again, and that could start leading into problems in the economy. Other than that, we know other durable goods, the earth-moving machines, all not good. The other major one that the Fed looks at, we know they've talked about the dollar. I already talked about it in the other keys, so I don't want to rehash there. And then the seventh one that nobody likes to talk about, it's kind of the redheaded stepchild, so to speak, is the stock market. If you don't think the Fed is looking at what the market is doing, you're fooling yourself. Academics believe that. The Fed is keenly watching the stock market. The lower this goes into the Fed number, the probably better off we are. If they rally this into the market into the Fed number, it gets a little bit more iffy. My opinion is that the Fed should not be raising interest rates here. If anything, they should be easing more. I've laid out for you a litany of reasons of contraction that are going on in the economy. The economy is not good. It is not doing well. It is not on an upswing. It is on a downswing. Yes, the policy should be to raise interest rates at some point. They had a great opportunity in 2013 when the economy really was in an upswing and you had an up 30% stock market. You have a very iffy, tenuous situation here at best with slowing domestic and global growth, with a fairly weak holiday sales season. I don't think that this is a really good point to raise interest rates into. Will there be a policy error? That is very, very possible. They have been talking a really good game here that they might want to hike rates, and if they do, I believe that will be a policy error that will have consequences a little bit further down the road. Let's talk about the market and what the market reaction might be to the Fed. So they're expecting, first of all, let's talk about levels. A lot of other people who I don't want to get into who they are, that I've seen post videos, they have S&P levels they talk about. If their levels are accurate, my levels are hyper accurate. Look at to the T. This is an unadjusted chart. I have made no changes to this since any other video. If you don't believe me, go and take a look. I've been talking about key levels. I talked about the SPY really needing to clear 210 for it to be sustainable. We had one of the things that I've been finding very frustrating in this market is that you're not having a lot of pattern follow through, and I'm going to show you that in a minute. So you had the look above here, you got into the close to the 211s here, you closed in the 210s, and then you fell out of bed. And then follow through to the downside. This should have cascaded lower, right? But no, we were up again, then down, and this has kind of been cray-cray. So below 210, there is no chance at highs. Above 210, there's a chance at highs. I said that we needed to hold 207s to really be that was really these lows in here. This was really this low here was 206.95. This low here was 207.43, so I had said 207s. Once we lost that, look at this. We were trying, topping tail. All of these attempted rallies were met with selling. Finally, and look, we had held here the tail line of my support, the 204.12. The low here was 204.18, so it was kind of close enough for government work, so to speak. And then once we lost there, I had said 202s. I had said 201.90. I believe we closed here at 201.88. Yep, so this has been working. So my question here is going to be, are we going to cascade lower here? Because this is really key. If we lose this area, I believe that we are into some fib levels. We could retest the bear flag breakout here of the 199.84. We all know 200 is a key strike in December expiration. I could make a case for that being kind of the low. We know a 50% fib. If we use the pull, there are two. The question here is now going to be if this does give, and I'm going to give the scenario where it doesn't give in a minute, but I'm going to say if it does give, where do we go? The question then becomes, do we use Fibonacci retracements from this low or this low? I believe it's going to be from this low, but it is possible from this low. That's why I have those on. That's on in the gray. I always put 61/8 in green, but let's assume this low. So if this does snap, we're talking about 199s, which is roughly around where that bear flag breakout was. If that gives, we have a range low. This is the true range low here. If we lose 197.87, like if this comes down here and kind of holds here, the market is injured, but it is not killed. If the market loses that, we are in a lot more trouble than I think people are going to realize, and I'm going to explain that in a moment. But keep in mind here, look, once we lost on this move here, once we lost the 201.12, there was a cascading effect. Could that be happening again here? It's very, very possible, but it might not be. We're going to discuss that scenario in a minute. Anyway, if we lose this here, we're going to easily see the 61.8. I'm willing to stipulate we could have a move down there, and we could even have a gap fill. I have a play on, I think I'm long 198 puts and short 2 times the 195s for next week. I think the break even, I forget, I think it's down here around this 61.8. So I have a play on for there. I really wanted to have a play on for this 202, but we're down there too quickly. So let's talk about here the scenario where this couldn't be, where this could maybe rally. And to do that, let's go back to our left. Looky here, what we had here, this type of a wild move, chop pattern. Could this be that scenario? I believe that it could be. This really, if the market is going to stay okay, really should hold here. Look at the volume distribution. You have the node in here, and then this picks up here. There should be responsive buyers here, people who are looking to buy the market. You had a pretty big, nasty move last week. The caveat is I don't love this consolidation. I would have loved if it was just straight down, but you had breakaway value here. The question is this going to be more like this, or is it going to be more like this? I think it could be more like this, at least into the Fed, because let's see how that goes. I think that if we're not down badly on Sunday, there will be some short covering, and we could have a move back up, at least to the mid-range, maybe to fill the gap here. So back, and keep in mind that that's key levels here, the 205s, 206s, look where these lows were and look where this breakdown took place. Would not shock me to see if there is some type of seller disappointment and we do rally back up here. That is a very viable scenario. Keep in mind, we have a 7-point expected move in SPY for next week. That's obviously moved up with the, with the VIX jumping to where it is. So let's talk about where that could take us. That would take us, if we, let's just assume 202 here, add on 7, that takes you back up to 209. If we, sorry, I just had to catch my breath there for a minute. If we do snap here, 7 points basically takes you down to that gap fill. I didn't pull this number, when I talked about my put ratio, I didn't pull this number out of my where. This was done with deliberate, all my plays are deliberate. It would take you to a move down to there. So I'm within, I have a technical reference low down there, and I have an expected move now there, therefore in my favor. Plus Fibonacci levels, also kind of a bit of a volume node. So we'll see how that plays out. I did it small. I'll be looking to add and maybe put on some more as we get kind of closer to the whites of their eyes. I might even wait until Wednesday, like right before the release. A little risky stuff here. Stochastics rolling over a little bit here off of a lower high. We could have a whoosh. This is very key. We're going to know Monday or Tuesday. The worst case scenario, I think, would be... I know this is going to sound crazy, but if we rally ahead of the Fed, I'm a little bit more nervous. Like if you do one of these, then you could have a sharper break after the Fed. If you have a bit of a cascade and a washout ahead of the Fed, like if we were sitting on 197.86, and we had some real panic into the Fed, I will be thinking long for the Fed no matter what their decision is, because there'll be some type of a relief rally, maybe even back up to these lows to 202. So lower into the Fed is safer if you're looking for a long trade. However, short term, we could have some type of a rally. Those are the levels. Use them at your discretion. So that was SPY. IWM, really not a pretty picture here. We are below the consolidation range. We're below the key level of the 201.58, below 117.37, below this range distribution here, which is in the 114s, and this is looking steamer style, looking like it's looking to come fill this gap to 110s. That has been a very pivotal strike as well. Also, you could see 109 is kind of key. There was some reference lows down here. So if IWM, comes down here, this could be key. I don't have it drawn in here, but I'm willing to bet that we're close to a 61.8 of this range. Let me draw that in here. Let's see if I'm right. I could look like a moron. Nope, I am exactly right. 61.8, really, really key level here. Isn't it amazing? You do this long enough, you could kind of eyeball these things. It's kind of like a good bartender, right? You go to a bar, you see them make drinks with those measurers, and you're like, if you're really good, you should be able to eyeball it. I have no respect when they use. Anyway, I'm sorry to get off topic, but I'm just trying to show you, draw an analogy. But I was able to eyeball it. This is really key here. The 61.8. We really need to hold. I sometimes find that 61.8s get pressed a little bit, so sometimes between the 61.8 and the 78.6. So we are really dangerously close to where this needs to hold, somewhere between here and the gap fill. If this starts really breaking and we're retesting here, I'm going to start getting a lot more bearish. On the other hand, the Qs are coming off of a new high, albeit incrementally higher. These are kind of equal highs. We're roughly below the 50, not even close to the 61.8. You can see that there's a lot of moving averages support. I believe that we could come back down into these levels in the next couple of days. Maybe there's a reference here. Why is this weakening? For a few reasons, and I'm going to go into the this is like FANG central here. If you're long a lot of the FANG stocks, by the way, and you're looking for some type of a delta hedge, I always call this sort of the football bet. This would be kind of like if you're playing, Super Bowl betting, you're long a team outright, and then you play the money line on the other team as your hedge. So if you want, and you're long, some big momentum, maybe buy some puts or put spreads or whatever, even outright short Qs as a hedge against, your FANG stocks. So this is coming in here. There should be some reference support right around into this reference low here, the 109s, and then even maybe into the fibs. If this came down hard into the Fed here around the 105s, I'd be looking to probably sell some out of the money puts or maybe even try a long attempt. Let's get into FANG Central. We've had some interesting kind of odd patterns going on here with Apple. It has been a story of support and resistance. You can see it's been in a bit of a down channel for a while. Here it's been in some kind of consolidation, but look, it's below the consolidation range of the highs. You kind of had a bit of a look back into it, completely fell out of bed into this area, and now was trying it was struggling to kind of reclaim into that area. You had a reversal bar here, a big engulfing one. This really should have done it and got you up, but stalled again, and now coming back down, kind of falling out of bed. So this could weigh on the market significantly, particularly NASDAQ, if Apple really does kind of fall out of bed. That's the, kind of the 800-pound gorilla in the room. I could see this easily coming back down and retesting into these 109s and 107s. I like this with some type of put ratio if you want to play for a move back down into there, near dated, of course. But you really need to see Apple clear this consolidation and these highs for it to really retest and reclaim these highs. I do at some point think that this gap will get filled, but I don't know where we're going to come from, if it's going to come from higher or lower. I like to see when trends change, and right now this is looking a little bit soggy. The ideal situation would be for this to, really have some type of a dramatic pullback ahead of their earnings, and then, have the, the IV really get jacked up, and then have the opportunity to sell some out of the money puts in this. The IV has been so low in this for so long that I haven't really been even playing in options in Apple for so long. If you are playing it, it's really just got to be directional. So that's Apple. Amazon. So Amazon got the 1.618 fib extension and got a little bit more. It's been consolidating up here, and I had talked about this as a potential short setup, believe it or not, either a long above, a breakout, or a short down below. And it's been really kind of weird how it's traded. Look, you can see you had a hammer here, here, a slight look below, but rallied up hard. Again, a look below, but kind of closed a little suspect again here, and then finally on Friday you had a bit of a break. I think a lot of this is sort of a liquidation break. These are poor highs, and often you have the back off before the repair. I do believe that this could have a little bit more momentum to the downside, considering you're kind of below all of these bodies. I think that it might want to see the 50-day moving average, which you can see has been a little bit of support in the past. It may even want to see the channel low and maybe get into a bit of a gap fill. So I'm a little bit cautious with Amazon as long as you're below the 660s. If you do get some type of a pop back up and oversold bounce to retest the breakdown, I think you can short against these, for right or right out against the 60 to 63-ish area. That's really where this body picks up. There should be some reference. Probably some people who were up in here who are now a little bit worried. I'd be looking for a right or right out short on a a retest there. If it goes through, you have good location, and you could just chalk it up to a false breakdown. But to me, this looks like it's got some legs maybe lower. More people might want to be locking in gains. Chipotle, a bit of an interesting story here. I had talked about some bad news coming out here, and the stock really not breaking down. I've been looking for this to go a lot lower, actually. I had talked about, I think one of the mistakes a lot of people make is that they look for it too fast. Like if you're long here and the stock's already down 200-something bucks, you're really looking to puke out your stock so quickly. The answer is no. A lot of people aren't as disciplined. They probably are playing the hopium game. But, to me, this was very interesting that you had... this was one of the, let me get back into more modern times here. Oops, let me get rid of that. So look at this. You had the big breakdown. This was on news, response rally back up, retest, and then a bit of a false breakdown here. And then again here, this was on some news of the, some more E. coli or what have you. And the stock was really having trouble going down. There was still a lot of juice in these puts. I was able to sell like 90 for the next week, $90 and $100 out of the money puts and still get like $1.30 for them. Those were like the 450s. And you can see there was some disappointment here, the short squeeze, and you got basically the move. It's still below the downtrend. It's a little bit iffy, but I don't think this is collapsing $100, between now and next week's expiration. I actually up here I had talked about I had the opportunity to roll those short puts into another strike, but then I felt I was playing directionally and I didn't really want to do that, and I just kind of I was looking to close them. They didn't close. I still have them on, but they're really worth very little. They have pretty much zero delta and zero gamma, so they'll probably fill on Monday or Tuesday and just be for 5 cents and closed. But this is, as long as you're below the 580 to 581, it's still vulnerable. But this is probably going to consolidate a little bit before you get the maybe a move lower or a move back up higher. I think the mistake a lot of people do is that they assume that they're going to get their end range targets immediately and don't account for chop and short covering. You're already down a real lot in a straight line here, and you're probably not going to get people who are looking to puke their shares so quickly right away. So that was Chipotle. Facebook, let me get into more modern times, really. So I talked about this pattern looking a lot like this pattern and my fear of it being a bit of a breakdown. History might be repeating. Look at this, though. The 50-day caught it. The 50-day pretty much caught it here. This is really, really key here. If we lose the 50, I would expect us to really come down and retest. The problem really is that this should have been a retest of the breakout. It didn't do it, and it got back up, and it's now backing off again. I would oddly, I know most people don't like to hear this when they're long, would love to see this retest into some of these Fibonacci levels. 96s were key. 93s were key. This would be a really healthy correction in my view. I would love for it to come back down here. Another one kind of like Apple that doesn't have a lot of premium in their options. I'd love to see the puts get a little bit jacked to sell those as long proxies. Please look where I told people to sell. I said the 1.618. A lot of people were stubborn. They didn't want to listen, and I'm sure now they wish they did. So never, and the same thing in SPY. I had talked, if you go back a ways back, I had talked about, the SPY reaching a 1.618 Fibonacci extension. A lot of people didn't want to sell it, and I think a lot of them are very sorry. Anyway, we're at a really do-or-die level here. 50 MA is key. If we do get some type of a gap down, this could be the opportunity to reload and shorting some of those puts. 99 is key, and then let's talk about 96s and 93s. I think that this area would be an amazing area to sell out of the money puts. That's Facebook. If you want to know a hedging strategy, if you're long shares in Facebook, go back and watch my Periscope video from Thursday. I discuss a really great hedging strategy for Facebook. Twitter, not one I've been talking about a lot. It's in danger of having a head and shoulders down here. However, this could be a secure low. It's a low with excess, bookended by two higher lows. A bar that really kind of changed the pattern, but we are kind of coming back more than we should have here. I think that this is really going to have to just prove themselves. I know that they're now advertising to logged off users or whatever. The story here is really monthly, the monthly average users, the MAUs, which have been atrocious. However, Periscope was rated the #1 app on iPhone for 2015. That probably got a little bit of excitement here. So we really need to hold these lows here. We're a little bit below them, which is a little nerve-wracking if you're long. This really needed to hold the 25s. It closed at 24.84. So let's see what happens on Monday. I think if you want to be long Twitter, I guess, maybe a little bit of a small size. I think it's got a lot of tax loss selling that's probably been weighing on this as well, and, kind of the lack of MAU growth. If you get below this breakout bar, the 24.34, unfortunately, I think it's going to be a short again. Google, I talked about this coming back up into here and this being a good opportunity to sell a little into. It has been rolling over a little bit. Google is not really an expensive stock on PE multiples, but look how this traded the last time. You did get a gap fill. Maybe this does it again. I like the idea of put ratios, playing for the gap fill and maybe a channel touch. So as this comes down, that IV jacks and you'll be able to get a wider spread on that put ratios. I like playing it that way. I don't know that this is going to completely fall apart, but it is below the earnings gap. Below 752.05 to me is a little vulnerable. You had a hold there, a bounce, and now kind of breaking. Be a little bit careful. You do have a 50-day moving average coming in. That could be a potential turning point. It's also this reference low. So I like buying one of these puts and then selling something further out of the money as a put spread or a put ratio. Netflix, I talked about this maybe looking like this here in the last video. It's taken a few days, but it is starting to bend back over. Again, another one I like with put ratios, or if it comes down into these supports to sell, out of the money puts. I just think it's a little bit overbought. It's having some responsive sellers at these highs. This to me was a really bearish day. All of these days really, except for this one. These two were kind of bearish. This one was a little more bullish because you closed above the bodies of those 2 days. But the next day, you had a look above, completely failed, and closed below all of those bodies, basically. You could see all of the bodies were closed below. You had some responsive buying off the 20, but now we're through it. I would think that we're probably going to see the 115s, maybe the 50, maybe the 100, 110 here, but I like playing put ratios for a test of channel low. I think that that would be constructive. If you can get back up above some of these bars, then maybe the pattern resolves higher, but in the meantime, it's looking to me a little bit like it wants to have some more correction in there. Tesla, kind of the same thing. It's just in a bit of a choppy phase. I said that you really need to see this pennant break for a move higher or a pennant break for a move lower. Right now, it's sort of just in nowhere land. I'm not really inclined to play it either way at the moment, honestly. It's into some areas here where it kind of needs to hold. It's been sold off a little bit. I guess with oil being weak, there's not as much demand for alternative energy types of plays. Price line held the channel low, got back up to a reference area, now kind of just chopping, rolling over a little bit. Maybe you get a retest again. Look what happened here. You rallied and then came back down. So probably could play some put ratios in this if you want. If you get a break of this area, then then the play is long. Right here, it's just in consolidation. So I would really need to see a break of the consolidation either up for continuation higher or a break of this consolidation for a continued play lower. I like I said, put spreads or put ratios, or if you want to play this, call spreads, I guess, would be the way to do it. Right here, it's sort of trapped between levels. You really need to see a break of that consolidation. And I'll end on WYNN. Trapped in a channel. Steve Wynn announced that he had bought the stock. I had talked about playing put ratios. I wound up taking them off just because it moved so quickly for it was for basically a haircut loss. They expired next week, so I didn't really want to risk it with the Fed. If there was no Fed, I probably would have left it, but we do have Fed, so I took it off. Anyway, we got the gap fill, so this would be a good area for right or right out. If you want to sell some out of the money puts or sell some put spreads, that would be the area to do it. However, this kind of took back the move a little bit too quickly for my taste. I'm a little bit nervous that there could be some more iffy moves lower, but let's see. We could use this bar's range below 62.07 to me would be more bearish. Above 66.33 to me would be a little bit more bullish, although you can see I have an old support here, 66.72. Anything below that to me is iffy, so we are on the wrong side of that. It's a little bit iffy, so it's kind of put up or shut up time right here based on the channel low. Anyhow, if you're not following me, follow me on Twitter. My handle is @JustinPulitzer. If you like this video, please hit the like button. Hit the subscribe. You'll get notifications when I post more of these videos or Periscope rebroadcasts or special edition videos. Anyhow, I will be doing Periscope on Wednesday after the Fed, and I will see you then. Let's have a good rest of our weekend, and cheers.